Hi, I'm Sam Tasker-Grindley, Head of Advisor Success here at Swoop, and it's my pleasure to be joined by David Rodriguez Campo. He's very excited about this weekend, the Champions League final. How are you feeling?
Nervous. No, not very confident, to be honest with you. But we'll see how we do.
What's your role at Swoop?
So I'm one of the senior funding managers here. At Swoop, we've got the debt team split out into two: unsecured and secured, anything involving a charge on property. And I'm one of the funding managers on the secured asset finance, invoice finance side.
Awesome. One of the things I want to talk to you about today, Dave, is the deadline for RLS is coming up very soon. Supposedly, it's the 30th of June.
Yeah, that's right. So deadline is 30th of June, right? However, one thing that many borrowers aren't aware of is that when a lender applies to become accredited under the scheme, they apply for an accreditation. That accreditation has a cap in terms of how much they can lend under the scheme. So as lenders are approaching the deadline, they're also approaching that accreditation cap and therefore are running out of funds to lend. So as they get closer to that cap, they start cherry picking amongst applicants, and as they reach it, they then stop lending under RLS. So where we had 12 active lenders last week, that number has halved this week, and we expect it to continue diminishing over the coming weeks. So my advice would be get in before lenders reach that.
Cool. I mean, I'm allowed to say this because I'm an accountant myself, but accountants like to wait right until the deadline. If we can give them a different deadline for getting in any clients they think might be accepted under RLS, what would you say is the deadline for it?
I'd probably say next week. We are seeing lenders this week actually pause applications. I think the last of our lenders would probably reach accreditation between next week and the following week. However, because of the time it takes to process applications and actually quite a ramp up in demand over the past couple of weeks, I'd encourage people to get in as soon as possible.
Cool. Presumably, it means for what allocation there is left that lenders are going to be super picky. What sort of businesses are most likely to be successful at this last minute?
So at this stage, obviously, despite the pandemic and understandably business having taken a bit of a downturn in the year of 2020 and potentially 2021 as well, despite that, lenders are still lending under their normal commercial credit models, and so consecutive profitable accounts are positive. A downturn in 2020 isn't really marked down on. However, lenders do like to see a bit of a pickup in 2021 as the UK, at least the UK economy, has gone back to business as usual. They like homeowners. Some lenders have that as a minimum requirement, and even the ones that don't also like strong personal guarantees despite not taking that security. And they like a long trading age. Of course, the longer track record you have and data, financial data that you have on a company, the more comfortable you can feel lending to them.
Brilliant. Thank you, David. That's a really good answer. Couple more questions. So, bounce back loan, coronavirus business interruption loan, recovery loan scheme. Who knows if there's going to be something next? Possibly not. But they've no doubt saved a lot of businesses in what's been a pretty difficult time personally and for businesses. With those gone, what does the funding landscape look like, and what can we expect over the next few months?
Well, it's interesting because actually the CBILS loan scheme and the recovery loan scheme are essentially just a spin-off of the ESG scheme that was that is available in business as usual. So prior to the pandemic, and it will be available post-pandemic. So what we expect with those schemes is for them to kind of merge into the ESG scheme moving forward. What that means is a drop to 50% government guarantee, and they won't have the restriction of not being able to take personal guarantees below 250,000. So I expect them to start offering personal guarantees. Now, lenders outside of the government schemes, we expect essentially the product types to start diversifying again. So whereas the likes of invoice finance, asset finance, VAT loans, R&D, HMRC receivable loans were really eaten up by the bounce back loan scheme, the CBILS scheme, and then thereafter the recovery loan scheme. We expect lenders to go back into those more kind of niche products where you really do have to place a focus on how you plan on using funds, right? The bounce back loan was a 5 questions asked have your money in your bank by tomorrow kind of scheme. CBILS, wasn't, you did have to go into more detail, and it was, looked at by underwriters. However, you still didn't have to go into much granularity as to how you were planning to use funds. As long as you were eligible and you had the financial to support it, you'd pretty much be approved. I think moving forward, as I say, the focus is going to be a lot more around how you plan to use those funds, what the economic impact of how you plan to use them is. Are you going to buy a piece of machine? Is that machine going to save you money as opposed to renting it if you're currently renting it? Or let's say, do you have a large contract that you need funding against? And are you raising invoices on, pretty hefty payment terms, so 60, 90 days? I think the focus will be a lot more around how you plan to use the funds. With that, lenders are going to start requesting for personal guarantees, and the security taken essentially is going to increase, right? The bounce back loan scheme, CBILS, set expectations for the provision of a personal guarantee. However, that's not how the normal economy would operate essentially. So what we expect is, as I say, the security to increase, but with that, because these government schemes actually have a pretty hefty fee that the lender has to pay to apply the scheme, the guarantee, we actually expect rates to go down on the normal commercial loan products, and we're already seeing that. So lenders that were lending under RLS now move into their normal commercial loans, actually charging much lower interest rates on their commercial loans than they are on RLS. But again, of course, it does come with a personal guarantee.
Yeah, that's really interesting. And with personal guarantees, everyone feels slightly on edge about having to do them. You can get personal guarantee insurance, can't you?
Yeah, that's right. So we've got lenders that can insure the personal guarantee that you provide up to, I think it covers up to 80% of the personal guarantee, and you can get it for facilities up to 300,000. Essentially, that is what we're moving towards. So again, where expectations were before that you could get 50,000, 250,000 with few questions asked and not have to provide any form of personal liability, we do expect that moving forward that is going to be a requirement. There are still going to be lenders that don't require a personal guarantee. However, that will come at a price where it didn't during the government schemes.